Welcome, everybody. I'm Charlie Bengal, the CEO of Remax Allegiance, and my co-host, as usual, is Amy Lassen, an associate broker with Remax Properties in Colorado Springs, and our special guest today, and this is a really special guest, and we are thrilled to have her on the show, is Linda de Marlor, also known by many as the Tax Lady. She's often described as one of the most engaging, fun, and informative teachers and lecturers in the greater DC metro area. She's revered all over the region for her intricate tax knowledge and fun-filled approach to taxes. Her firm serves over 3,000 clients worldwide, working in TV, radio, medicine, real estate, law, politics, and professional sports. Her firm's name is Tax Masters and has 20 people on staff comprised of CPAs, enrolled agents, career tax specialists, and certified financial planners. So, Linda, welcome to the show.
Thank you so much, Charlie. And of all my clients, my favorite ones are my realtors.
Oh, well, thank you.
You're my specialty.
And this show is kind of a window into your discussion with us next week, which will be live and in person on Wednesday, February 19th, breakfast at 9:30 at Busboys and Poets in Shirlington, and the program will kick off at 10. So those seeing you virtually today will be able to see you live and in person next week, right?
Yes, and I'm bringing my magic wand and all my loopholes.
Of course. Yes. The world famous magic wand. We will have to get a picture and send it to Amy since she won't be able to join us in person. So let's start with this 20% deduction that I keep hearing about. And so is that the biggest change to the tax law that realtors need to know about? Can you kind of get into that a little bit?
I really feel that it is because it's a super deduction. It's available to everybody who's self-employed up to a certain amount of income. But the best thing about it is that it's not only available if you're a realtor and self-employed, but also you can take it for many other occupations also. But in any case, how would you like if I told you, Charlie, hey, this year, would you like to pay 20% less tax to the federal government?
Tell me more about that, Linda.
Yes. Well, here's how it works. So usually a picture is worth 1,000 words. And if I had my flip chart here, I'd show you. But let's just say we have a realtor who makes $150,000 a year. And of course, they have a really good tax accountant. So the tax accountant comes up with $50,000 worth of business deductions.
Okay.
Now, by business deductions, I'm talking about just their cars and their home office expense and all kinds of juicy business deductions. So that leaves them $100,000. Do you want to pay tax on $100,000? Say no.
No.
No. Okay. Well, the government then says, well, how about a 20% tax cut? So 20% of $100,000, that's a $20,000 deduction that you might be entitled to.
Okay.
Now, there's a couple other things you have to do. But let's say that that person had $30,000 worth of personal deductions. Now, what's a personal deduction? That's usually the mortgage on your home, your real estate taxes, and maybe you're generous with charity. So that person's now their taxable income is down to only $70,000. So then you take the 20% of the $70,000, which of course is 14, and compare it to the 20, and you get to take. Guess which you get to take, the bigger or the littler? The littler, of course, yes.
Of course, the littler, because we're talking about the
littler,
government.
yes. So instead of the whole 20, you're only going to get the 14. But 14,000, that's a deduction that you never had the year before. And this deduction went into effect in the year 2018. So on the return that you did last year for 2018, if you look, be very careful, look on page 2, line 9, and you'll see where it's entered QBID. You know what that stands for? Qualified Business Income Deduction. And if you don't have an entry on that line and you did make a profit from real estate, maybe you want to have somebody else look at your tax return and make sure that it was prepared properly. Now, some of your viewers, they may have already filed their 2019 return. I don't think so, but it's possible. But on the 2019, they changed it. So on the 2019, you have to look on page 1, line 10, and it says the same thing, QBID. And now there's even a new form on which to calculate it. It was so new back in 2018 that there wasn't even a form. They had to be attached or anything else. You just had to know what the number was and stick it on the return. Now, guess what happens if you put down the wrong number or if you leave it blank, do you think IRS is going to call you up and say, Charlie, you missed a deduction? Or
I think
Charlie,
not.
you put down 14,000, but it should have been 14,285. No, 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 no. They're not going to do that for you. So make sure that whoever is preparing your tax return actually knows how to fill out the QBID deduction.
Got it.
Is there any more detail you'd like me to give you? It's a wonderful thing. You don't want to lose it. Now, after a certain amount, it does disappear, or goes,
Okay.
it goes down. So if your taxable income after all deductions is over $160,000 if you're single, and if you're married and your taxable income is over $320,000, there's another limitation that comes into effect.
Okay.
But if you have a good tax accountant like us, we will figure out all the loopholes to make sure that the 20% deduction doesn't get lost anywhere.
Okay.
Does that make sense, Annie?
Yeah, awesome. Good. Amy, any questions so far?
Well, I think my nitpicky question is too nitpicky. It was about her word profit. We can skip it.
Okay.
When she said, make sure you've shown a profit. And I thought, wait a minute. Anyway, that's a whole nother.
Oh, well, I'll come back and do a show for your rookies who are just starting out, because many people the first couple of years they're in real estate. And by the way, I've been in real estate all my life too, although I don't use my license, I just keep it. But when you're first starting out, of course, there's probably going to be a loss. Now, of course, that loss, you don't want to lose it. It's available. If you're married, you can take a loss against your spouse's income. And if you're not married, you can carry forward that loss until the next couple of years when those big real estate commission checks start rolling in.
Right.
So did that sort of help you with the
Sure,
profit
that helps.
problem?
Thank you.
Okay.
Okay, awesome. Let's move on to entities, LLC or S Corp, and why.
Oh, I love entities. You know, that question, I spend an hour doing a class on it, so I'll try and give you a briefer answer than 60 minutes. First of all, what's an entity? An entity is something different from the taxpayer. So Charlie Bengal, he's a taxpayer. But if Charlie Bengal wants to have a separate entity, he can form an LLC, also a C corporation, an S corporation, and you have all these options. Now, if you're a realtor, in my opinion, you should immediately become an LLC. Okay. Now, what does that stand for? It stands for Limited Liability Company. It's got nothing to do with being a corporation. It's a company. So it gives you lots of protection. And I'm not a lawyer. My daughter's a lawyer. She sets them up and she'll tell you this. But I feel that it gives you as much protection as a corporation. And it's sort of like you've just built a brick wall around your assets. So what this means is that if you were to get sued for something you did in business, then usually the most that they can take away from you in a judgment or something would be whatever assets are owned by your business. Well, what does your business own? It owns your computer, it may own your car, but they can't take your house or your retirement account or your children or anything like that. So first we start out as an LLC. Now we go to the next step. Do you want to save money on your taxes? That's a good question. An LLC doesn't have any tax consequences whatsoever. It's strictly a protection. But if you want to save money on your taxes, a really good way to do it, and also to limit how much you pay into Social Security, and I'll cover that argument later where people say that Social Security is a good investment, which it isn't. But anyway, you can limit how much you pay for Social Security tax by forming an S corporation. Now your LLC comes first, and then you be an S corporation by election. As an S corporation, you elect to pay yourself a salary. So Charlie says, I'm the president of my corporation. I should have a salary. And you pay a salary, but the rest of the profits from your corporation are paid to you as just profit. So they're not subject to the 15.3% Social Security tax. And this 15.3% tax, I call it the insidious tax because you really can't get out of it. Anybody who's self-employed for any reason, no matter what you're doing, the minute you make $400 or more, you're required to pay the 15.3% tax. Now, it doesn't go on forever. It stops, let's say after you've grossed $200,000 and you have some business expenses, well, then it goes down to only 2.9%. But really on the first 150,000 you own, you can count on owing the 15.3%. So
Okay.
by limiting your profit and taking some of your profit as a salary,
Mm-hmm.
you eliminate some of that tax. Now, there's another way also to save on Social Security tax, and in my opinion, it's even better sometimes than an S corporation. I have my clients form a C corporation, which
Okay.
is a little bit different.
Mm-hmm.
In that now they're allowed to deduct all of their medical bills as a business expense, whether they're married or whether they're single.
Okay.
And by doing this, what happens is you say, well, I'm president of my C corporation. I think I should be entitled to some deductions. Let's
Mm-hmm.
put that in writing. So we have our clients, we fill out a contract for them, and they'll say, I think I should be able to deduct my car. You agree about that, don't you?
Sure.
Yes. And then you should be able to deduct expenses for your home office. Yep, that's reimbursable. Yep. And then, oops, how about we deduct medical bills? So from that day forward, since you're the president of your corporation, every medical bill you get, whether it's for dental or your contact lenses, glasses,
Mm-hmm.
insurance, prescriptions, co-pays, anything that any bill that comes in gets paid out of your C corporation. And
Okay.
that takes the income right off the top, which means it saves you 4 taxes: federal, state, Social Security, and Medicare. Normally, you can't deduct any of your medical bills at all. Medical
Okay.
bills basically are really non-deductible because they have to exceed, well, this year it had to be 7.5%. Next year it's 10% of your
Mm-hmm.
income. Just as an example, let's say we have a married couple and their adjusted gross income is $100,000.
Mm-hmm.
Well, 10% of that is $10,000. So if they have $9,999 in medical, they could deduct zero, nothing. But if they have $10,100 in deductions, now they can only deduct 100 of it. So either way, you either have to be very sick or very poor in order to claim medical. But once you become a C corporation, your medical bills are deductible off the top. So basically what I've done, you know what alchemy is, where you turn lead into gold?
Mm-hmm.
I
Yep.
just took non-deductible personal medical bills and turned them into fully deductible business expense. That's golden.
I
So
like it.
that's a good reason. So I love LLCs, I love S corporations, and I love C corporations. But this isn't something that you just go to a lawyer and decide on. Because if the lawyer's smart, what the lawyer's going to do is call your accountant immediately and ask them which is better. Because the lawyer doesn't decide the tax consequences of the corporation.
Okay.
The accountant does it. And don't just go to one of these online places and start downloading LLCs or downloading things. I had a realtor who was in my class a couple weeks ago, and she was a lawyer, and she got tired of working the long hours in law, and she became a realtor. So she had done her own LLC. So I told her to send it to me because she had downloaded it. And guess what was inside of it? She had a debt restitution order inside the formation order. So a debt restitution order called the DRO, that meant that she was responsible for anything that the LLC couldn't pay. So she had just defeated her whole purpose. So I said to her, what kind of what kind of law did you practice? She said, well, I was a communications lawyer. Well, that's got nothing to do with forming LLCs. So don't try, you don't take out your own appendix, you don't cut your own hair. What you want to do is go to a specialist. And somebody once told me, if you think that a professional is expensive, try using an amateur.
Right. Yeah.
So
that is a great quote. Yes.
Yeah, I should put that in my office for our clients, but they never complain anyway. They love us.
Good.
I'm sorry if I took too long on that question, but I get really excited about medical reimbursement plans. Yeah.
So is a sub S LLC still the best way to run our business for as agents? Still avoids the self-employment tax question mark? That was one of the questions from our audience.
Yes, in many ways, an LLC, which elects to be taxed as an S Corp, is very good. However, if they want to be able to deduct their medical bills, then the LLC can elect to be taxed as a C corporation.
Okay.
And if the person is single, then there's another way around it. There's different ways of getting to the same answer. But I love LLCs, and I love Subchapter S, and I love C Corps, all of them.
Okay, another question kind of having to do with entities. This comes from a woman in Wisconsin. My business is an S Corp, and I would like to learn if I could buy or lease a pickup truck for my business as a tax write-off. As it is now, I own my vehicle and deduct mileage. I wouldn't mind having a second vehicle that the company owns.
Absolutely no problem whatsoever. You can own and use as many vehicles as you want. I have a client, he's single and he has 4 vehicles. We deduct about 80% of the sedan that he drives, and we deduct about 80% of an SUV that he has. And he also has a pickup truck, and we deduct 80% of that. And well, he's got an old Mustang from high school.
Mm-hmm.
We don't deduct that one. So we have 80, 80, and 80, which is 240%, which is better than deducting 100% of one of his cars, isn't it? 240
Yes.
is much better. So to answer her question, first of all, yes, I think up there in Wisconsin, you really deserve to have a truck. There's a lot of, it'd be an ordinary and necessary expense. And you can have as many as you want. But let's say that the main vehicle that she drives, maybe she uses that 70% and
Mm-hmm.
maybe the truck 70. So that gets her up to 140, which is better than 100% of one car. So as many as she wants, and she can deduct them either way. So if she's taking the mileage on the car that she already owns, then she can set up the new truck any way she wants. But she has to be careful, because there is a problem sometimes when you buy a new car.
Mm-hmm.
If the accountant sets it up the wrong way, then you're stuck. You can't change back and forth depending on which is better for you. So this is another thing, like, don't do this at home. Don't think that I was going to say the wrong word. Don't think that one of those home help programs. I pay $31,000 every year for the tax program that we use in my office
Mm-hmm.
to help our clients. So I think my $31,000 program does a better job of deciding what's best for the client.
Right. Than the free one, right?
Yes. Those they just scare me to death, because then they have all your information. Oh my gosh.
Sure. Yeah.
Ooh.
Amy,
Charlie, I wanted to back up to the S
Yeah.
Corp and C Corp.
Please do.
It sounds like the C Corp has so many benefits. Like, it sounds significantly important that those of us who are operating as a subchapter S should change. So what would be the reason not to do C Corp?
Okay, the C Corp doesn't have the entitlement to the 20% deduction, number one. However, thanks to the new tax law, the tax rate on the C Corp has been dropped. It used to be 35, now it's 21%. So let's talk about a person who's single. As soon as they have $38,000 of taxable income, they're already in the 22% tax bracket.
Mm-hmm.
Or if it's a married couple and they have $77,000 or more taxable income, they've already graduated to the 22% bracket. So right there, just by being a C corporation, you are in a little lower bracket. Now, many people, I know there's some accountants out there watching this, and they're going to say, oh, but what about the double taxation? Well, if you structure it properly, and if I can get my client to put money into their solo 401k and to put money into their medical reimbursement plan, we will figure it out so the corporation won't even show a profit. So if we can save them enough money to make the C corporation worthwhile, that's the way to go. Now, you don't have to be a C corporation to have a medical reimbursement plan. If you're just an LLC, or if you're just self-employed and you have a spouse who helps you with your work, you can still have the medical reimbursement plan. The only people who must be a C corporation in order to deduct their medical are the single folks, because they don't have a spouse that they can say is their employee. So I teach another 90-minute seminar on these medical reimbursement plans, but we can do that someday too, if you like.
But so to clarify, it wouldn't have to be a spouse. It could be any employee, right?
Yes, but here's the thing. Let's say you hire your significant other and you give them the medical reimbursement plan. That's great. Now you get to deduct all of their health insurance and all their medical bills, but they can't come to you like a spouse could come to you. And the spouse could say, hey, boss, last week my wife Amy was very expensive. She spent $400 on those beautiful black glasses, and I went to the dentist for $800. So now, out of your business account, you could write a check to your spouse, which will cover not only their medical but also your medical. Whereas with a significant other as your employee, you can only reimburse them for their personal medical. You see the difference?
Okay.
Yeah. And you can also hire your children too. My son, who now runs the company, if you call him up right now, he'll tell you that in the old days when we only had one building for our offices, that on Saturdays he had to empty all 11 trash cans. Now I don't know how many trash cans we have for everybody, but he remembers being, earning money for his, what was it, a Sega or a Genesis or one of those computers.
Yeah, right.
So hire your children. And by the way, this year, the children can earn $12,400, and if they're under the age of 18, they don't pay any federal, state, Social Security, or Medicare tax. So here's a good chance for you parents and grandparents to hire your children or grandchildren to help you.
Interesting. Yeah. So that was actually one of the questions was what's the minimum age to employ our kids and how much can we pay them to do our office work?
Oh my goodness. Oh. Well, just in honor of that question, I can send out to everybody if they want one of our calendars.
The world famous calendars.
The world famous calendar. And on the back of it, there's pictures of my 6 grandchildren. Now, of course, they got a modeling fee, didn't they, for being on the calendar?
Right.
So you can, and they're only little. They're only like 6 years old, 4 years old. So you can hire a child at any age. Now we have to be reasonable. I can't pay my grandson Oxley $4,000 for doing something that he's not capable of because he's only 6 years old. But I can pay him for something. But many people have teenagers or children. I have a lady whose son does all of her communications and her computers, all of her IT, and he's only 17 years old. So she'll be paying him $12,400 this year. And of course, if she paid someone who was a stranger, it might have even been more. Because her son is on call 24/7.
Right.
So as long as it's ordinary and necessary, and as long as it's what you would pay a stranger to do the same amount of work, you can deduct it.
Got it. Good. It's not one of the questions that we had discussed previously, but talk to me about a SEP versus the solo 401k. You and I have had this discussion over many years, so I wanted to touch on it again today.
Yes, absolutely. SEP, bad. 401k, good. That's what you need to remember. Because 20 years ago, when Congress got worried that people weren't putting money away for their retirement, because the Bureau of Labor Statistics published some statistics saying that 95% of all retired Americans were financially dependent on either their Social Security, welfare, their church, or their children. They decided they needed to encourage people to put money away. So what did they do? They invented the solo 401k or individual 401k. And the reason why you want to have the solo 401k is because it is a qualified plan. An SEP and an IRA are unqualified plan. Now you're asking me, what's the difference? Okay, the difference is that a qualified plan has 3 things that make it important. Number 1, it is 100% protected from lawsuits, creditors, and bankruptcy.
Okay.
I'm going to repeat that. 100% protected from lawsuits, creditors, and bankruptcy. A SEP is not. It also allows you to put more money into it. This year, you can put $63,000 into your 401k. And of course, if you're over age 50 like me, I know you can't believe it, you get to put in an extra 6. And the third reason is at any time, no matter what your age, you can borrow from your solo 401k and use the money. Now, hopefully you're not going to take the money out to buy a motorcycle or a boat. But what I want my realtors to do is to take the money out to buy an investment property. I've done it myself, and it's a wonderful thing. You can borrow the money for any reason for 5 years. And if you're borrowing the money out to buy your own home where you're actually going to live, then you can have a 15-year payback. Okay. Now there's some limitations on how much you can borrow, but you always have to pay 5% interest. But who are you paying the interest to? You're paying it to yourself.
Yeah, to yourself, right.
Okay, so your 401k continues to grow, whereas if you take money out of a SEP or an IRA, not only do you have to take the money out, you have to pay federal tax, state tax, and of course, if you're under 59 and a half, that awful 10% penalty. And I'm going
Okay.
to, when I do the seminar next week, I'll have my PowerPoint and you'll see how right I am, because I'm always right. If you don't believe me, ask my ex-husbands, they'll tell you.
So the calendar, Amy, is world famous, as are the ex-husbands.
Ah, nice.
I'm sorry.
Okay, good. So questions about that, Amy? You and I talked very briefly about solo 401k and a SEP. I think it seems like it's more common that agents have a SEP. And I mean, I had a SEP for years, and then we would have you in almost every year and you'd tell me, stop it, Charlie, convert it, whatever. And it took me years and I finally did it. But I almost wonder, why do most realtors have a SEP? Because it's easier to set up. I mean, how do people go down that path, I guess, is my question, if the solo 401k is so much better to begin with?
It's really easy. They go to a bank or to an investment advisor or to a financial institution who don't sell 401ks.
Okay.
So they're going to sell you what they have. They don't care about you. They don't care about whether the money is protected or that you could borrow from it. And, a 401k, it costs $160 a year. That's what I pay for mine. That's what you pay for yours.
Okay.
And by the way, the $160 that you pay is fully deductible. So you can deduct it from your federal, state, Social Security, and Medicare.
Okay.
That means you get back about $80 on your tax return. So for $80 a year, you now have your money 100% protected from lawsuits, creditors, and bankruptcy. And you can borrow from it and you can put more money in. And this is why I tell people, you've been going to a tax accountant for many years. This law changed in 2001. How come your accountant hasn't read any of the new laws? Or how come your investment advisor, who's supposed to care about you and your money and your future and your retirement, never told you about something that's been around for 19 years? This is how we get a lot of new clients. Because
right.
Yeah, absolutely. Now, I don't sell 401k. I don't get a commission if you buy one. I'll sleep better at night if I knew that everybody in the United States had a solo 401k. And if you like, I'll give you the name of the gentleman who does mine, because I love him. He's a certified financial planner. And like I say, for $160 a year, you can't beat the price.
Right. Okay.
That's the loans you can do.
Another question that we didn't discuss ahead of time. There are agents out there watching this that are behind on their taxes. And we know this. We have agents at any given time that have garnishments, right? We're a big company. It just is bound to happen. So I'm an agent. I'm behind. Let's say I didn't pay my quarterlies last year. I'm behind. Where do I start? Like, how do I dig myself out of this hole? Because that does keep me up at night, right? Thinking that agents are behind on their taxes. Yeah.
Terrible. It's terrible. And I've been dealing this for 30 years with my clients. The first thing you want to do is talk to an accountant who's got connections with IRS. Okay. We have Steve on our staff who used to work there. So that's our connection. But anyway, the second thing you want to do is have that person look at your last 3 years tax returns, because unless they were prepared properly, there might be lots of deductions to which you're entitled that haven't been claimed. The first thing that comes to mind always for me is an office and home expense. Maybe it wasn't claimed, and that averages as a $3,000 deduction. Right there saves you $1,500. So if you owe $1,500 less to internal revenue, you should be really happy.
Sure.
So if you can amend any of those last 3 years tax returns, your bill goes down. And the problem with owing taxes is it's not so much the tax owed, but there's a lot of penalties involved. The state of Maryland, DC, and also Virginia, they charge 13% penalty and interest on unpaid taxes. That's almost confiscatory. The federal government only charges 6%. So if you can lower the tax bill to begin with, and then have the your person who's helping you negotiate, and many times the penalties can be negotiated out of. You can never get out of the interest. They always want their interest. But the penalty which is not deductible, and neither is the interest, by the way. So what you want to do is get the taxes as low as possible, then start negotiating. And we do this all the time. In every speech I've ever given where there was at least 20 or 30 realtors, there's always one person who comes up to me afterwards and said, I haven't filed for 2 or 3 years, or 10 or 12. I said, the IRS is ready to garnish me, and I don't want my broker to know how naughty I've been about not filing or filing behind. So we can help them out. And or any good accountant, but make sure that the accountant, number one, has experience with self-employed people, especially realtors, and that they have somebody on their staff who used to be at IRS and knows the magic numbers to call.
Okay.
Like my Steve. By the way, ladies, Steve is single, and he's a ballroom dancer, and he's a good cook. Steve Bradford. Highly recommend him in every way.
Nice. So don't ignore the problem, I think, is really step one, right? Don't ignore the problem because it's not going to go away.
That's right. But it could be made less if
Right.
those 3 years returns have been refiled. Or maybe what happens is sometimes IRS, they don't get any tax return. They automatically assume that, okay, so you made 100,000 last year. So they tax you on the whole 100,000. So you think you owe 40,000 tax, when by the time we actually do the tax return, and we'll take all their business and personal deductions and go back and put in everything necessary, they might only owe 3,000 or 4,000 instead of 40. I see this happen all the time because the IRS does a substitute tax return, and they don't just automatically put in any deductions. No, they just start at the top and that's it. Bang.
Okay.
So it can be less. And besides, you don't want to talk to IRS. You let somebody else handle it.
Okay. Yeah, Amy and I were introducing a vision that I have for my agents on our show. And we started last week. We did half the vision. And next week, we're finishing the vision. And one of the pieces of the division, or of the vision rather, was taxes paid, as in quarterly. No one is behind on their taxes, right?
Yes.
It's such a big problem.
Yes, well, this is also a case where by being a corporation and having a salary, we can adjust the salaries withholding so that that doesn't happen. But no matter what happens, whoever's doing your taxes, we always send out a quarterly letter saying, don't forget, tomorrow's the day, or next week is the day to send your checks in. Because you need, a lot of people need remind. Even I forget sometimes, and I'm the one who's talking about it on TV and radio all the time. So even I've forgotten.
Okay, awesome. Amy, any last minute questions, comments?
Well, I have a simple question maybe. Charlie and I mean, Charlie has all of his agents there in the Maryland, Virginia, and DC areas, you know, who would probably be able to take advantage of your services. But I don't know that all of our coaching clients, Charlie, who may be watching this in many other states, this is a really naive question perhaps, but is it super important that you get a tax professional who specializes in your state's tax laws?
It's not absolutely critical. And I'm not saying that because we need new business, because we're always fine with what we have. But we have clients in 30 countries and in 40 states all over the United States. So we can help you. And if we can't help you, what I'm always willing to do is look at what the tax return that was prepared for you in the past. And then, of course, I get out my red pencil and then I start circling all the lines where there should be deductions that are missing, whether they've taken your office and home expense, whether your car has been claimed properly, and of course, that all important contribution to your retirement account. So it doesn't have to be in your same state. I know many people would like to have somebody they can visit with. Although, you know, it's amazing how many of my out-of-state clients come to visit us for their appointment during the Cherry Blossom Festival.
Oh, well, that's convenient.
Yes, and they can deduct their trip because they've established a relationship with us. I have some clients, for 20 years, they've driven up here from Florida every February to get their taxes done. And we keep telling them, Mr. and Mrs., you don't have to come. We can put you on extension. You don't have to drive from Florida in February to Washington. You don't ever have to come and see us. But like I say, we have clients we've never met. I was just talking to a client in Singapore yesterday who we've never met. We've been doing their taxes for 10 years. We keep telling them, come visit us, you know, but they don't need to be here.
That's awesome.
There are Americans all over the world working they're in real estate, by the way. And by the way, every time I go to all these countries, I see the RE/MAX offices everywhere. Good heavens, I don't think I've ever been any place in the world, from Africa to the Middle East, everywhere. You see, of course, in Europe, RE/MAX.
Yeah, right. Yeah, appreciate the plug. Yeah. I think we're up to 120 countries, I think. Yeah.
Is that it? Okay, then I've only been to maybe 100, so that's good. Okay.
Awesome. So again, next week, so we only got to maybe half the questions, right? So next week, Wednesday, February 19th, 9:30, Busboys and Poets in Arlington. For those of you local in the DC metro area, if you guys want to get in touch with Linda and her team, taxmasters.com, and there is a dash between tax and masters. So tax-masters.com. Any last minute thoughts, Linda?
Oh, don't be in a hurry to file your tax return. Everybody thinks, oh, I have to file on time by April 15th. No, 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 no. It's better to go on extension and have somebody who knows what they're doing file your tax return. Please don't try to do it on your own. It's not going to work, especially with the, we've had a new tax law in 17, 18, and 19. So there's 3 new tax laws. And unless you keep up on all this stuff, you're not going to be able to do it yourself. And you don't want to miss a deduction. That would be terrible.
Agreed. Awesome. Linda, always a pleasure. Amy, good to see you. You all have a great rest of the day. And Linda, I will see you next week.
Yay. Thank you.
Take care. Thanks again.
Thank you,
Bye-bye.
honey. Bye-bye.